Hey everyone, and welcome. Today we're diving into a really interesting tool in the world of investing that's been getting a lot of buzz lately, the Specialized Investment Fund. So first up, let's set the scene a little bit. We're going to look at a classic problem that a lot of investors run into when they're ready to move past their usual investment plan.
I want you to imagine this for a second. A 10 lakh rupee bonus just landed in your bank account. Awesome, right? But after that initial excitement wears off, a huge question pops up. What's the smartest thing to do with it?
Look, your monthly SIFs are fantastic for building wealth steadily, but a big lump sum like this, it just feels different. It feels like it calls for a more powerful, maybe a more sophisticated strategy than just your regular monthly investment. So, if the usual plan doesn't feel like the right move, then what does? Well, let's talk about an option that was designed for this exact kind of situation, the Specialized Investment Fund, or as you'll hear it called, an SIF.
So what exactly is a specialized investment fund? Well, you can think of it as a kind of hybrid fund, but with a really cool trick up its sleeve. It's built to make money not just when the market is going up, but also when it's going down. How on earth does it do that?
It all boils down to one single game-changing feature that you just won't find in a typical mutual fund, and that is the ability to short sell. Honestly, this is the secret sauce that changes everything about what the fund can do. Because of this, the fund manager isn't just stuck buying stocks and crossing their fingers that they go up. They can actually take positions that make money when a stock's price falls. That's a powerful tool to have, especially if you want the potential to get returns even when the market is crashing. But why do these things even exist? You know, every financial product out there was created to solve a specific problem for a specific kind of person. So let's dig into who exactly SIFs were built for.
Okay, so picture the typical investment landscape. On one end of the spectrum, you've got person A, the salaried professional who's super disciplined, investing every month through their SIPs. And on the other end, you have person B, a high net worth individual using those expensive, tailor-made portfolio management services, or PM.
But what about that person who's kind of stuck right in the middle? You know, someone who's successful, earns a great income, has a good chunk of money to invest, but maybe isn't ready or willing to pay those really hefty fees for a high-end PMS. Where does they turn?
And that's it. That's the answer. SIFs were literally created to fill this exact gap in the market. They offer a more sophisticated way to invest for that in-between person who's ready for something more than a basic mutual fund but doesn't quite fit the PMS mold.
You know, probably the easiest way to really get a handle on a new product is to compare it to something we already know inside and out. So let's put an ETF and a traditional mutual fund right next to each other and see how they stack up. All right, so the biggest difference right off the bat is strategy. Mutual funds are typically all about buy and hold for the long term. SIFs, on the other hand, have a much more flexible long-short strategy. That means a mutual fund can only buy stuff. An SF has the added flexibility to short sell. But here's what's really interesting. The rules for taxes and fees, they're exactly the same, so that part at least is familiar territory. Okay, we've thrown this term short selling around a lot, so let's just make sure we're crystal clear on what it is. It's basically making a bet that a stock's price is going to go down. For instance, if a fund manager thinks a stock trading at 100 rupees is way overvalued, they can borrow a share and sell it at that price. Then, if they're right and the price drops to, say, 80 rupees, they buy the share back, return it, and the fund pockets that 20 rupee difference. So can just anyone start offering these funds? Nope, not at all. It's not a free-for-all. The regulations are pretty strict. Only established, existing mutual fund houses that have a proven, licensed track record are even allowed to launch SFIFs. And that's a good thing. It ensures that these more complex products are in the hands of experienced, regulated professionals. This all sounds pretty interesting, right? But the most important question of all is an SIF actually right for you? So let's do a quick little litmus test to see if this is something that might fit into your financial picture. First things first, and this one's a big hurdle right at the start. The entry ticket. The minimum investment you need to get into an SIF is typically set at 10 lakh rupees. So that's a major qualifying factor right away. So an SIF might be a good fit if you find yourself nodding along to these points. You're an experienced investor, and you feel ready to take a step beyond traditional funds. You've got that minimum 10 lakh to invest. And this one is crucial. You understand and are genuinely prepared to take on a higher level of risk that comes with these kinds of advanced strategies. And please, if you only take one thing away from our discussion today, let it be this. An IF is not meant to replace your core mutual fund portfolio. It's not one or the other. Think of it as an additional tool, a specialized instrument that you can add to your investment toolkit for more diversification.
So, that brings the final question back to you. Now that you've got a handle on what an SIF is, who it's for, and how it works, is it maybe time for you to consider adding this new tool to your own investment strategy?